In this video, we are going to go over ICT concepts, but more importantly, we're going to go over market structure shifts. So let's just get straight into it without wasting any time. So as you can see, I've drawn out this little diagram here where I cover essentially price action, right? And this price action is fairly standard. We're likely to see variations of this. It's not going to be exactly like this, but when we're looking at our charts, we'll be able to see price action like this. So as you can see, we're moving downwards. We come to an area of quite choppy price action, and then we move upwards, right? Very understandably, we'd be able to take trades from here. So this region here where we're moving with trend. So this will be a very fairly easy setup to take. And then we get to an area of we can say choppiness, but also a reversal area. Now, the problem I see with most traders is, and where they generally go wrong, is trying to trade this choppy area here. So either you're getting in too early, or if you're getting in, you don't see where the market structure shift is properly. And that's because your idea and your learning of structure is incorrect. And essentially all you have to do is learn what is important when it comes to structure, what isn't important when it comes to structure, what are the few things you need to be looking out for, and how to identify them, and then move forward and actually trade using them. One thing that a lot of people do when they look to take trades from structure, looking at market structure shifts, is they do something called they qualify in. So they're qualifying why it's a market structure shift, but they're not qualifying why it's not a market structure shift. And because they're not qualifying out, they get caught out, and so they end up taking trades that cause them to lose. Now, their bias might be right, their daily bias might be right, they might be in the right time zone to take a trade in terms of kill zone, but they're not taking it and they're not winning the trade because their market structure is wrong. And market structure, in my opinion, is one of the most important aspects of trading in the first place. So let's just break down this diagram very quickly. So we're moving downwards, we get this choppiness, right? Now, when it comes to the choppiness, where are we going to find the most important high that price needs to break? Okay, so is it this one, is it this one, or is it this one? So if you've got a chance, pause the video and have a look and think which one it's going to be. And I want you to have a clear explanation why it's that. Now that you've done that, let's see if you've got it right. So let's have a look at this price action, right? So price is coming down. We get a lower high, lower low, lower high, lower low. Notice how the lower lows are lower than the previous lower lows. Okay, same with the lower highs. I mean, this could be higher, it doesn't really matter, but it's causing consecutive and continuous lower lows. Now when we get to this point here, this lower high pushes down, but we don't get a lower low. It's not lower than this low here. So we call this a weak lower high because it wasn't strong enough to break this lower low. And now if I just earmark that out, so now this is the lower low that we need to break. So we're looking at which lower high out of these three, right, is going to give us the lower low that breaks this. Now another way to look at it is there's liquidity here, etc. But if this lower high is higher, it's not strong enough, and that means that lower high, this lower high is not the lower high we want to be broken for a market structure shift. So for example, right, so let's say this one's lower and price doesn't break this. There's people that won't take this trade to the upside because they're looking at the this lower high to be broken, because they say no, this is a true lower high because it led no, right? When price moves away from here, it needs to break this low. It hasn't broken this low, so it's weak. This one hasn't broken this low, so it's weak. But this one, so if you get rid of that one and that one, but this one pushes through and creates a lower low. So now this is the true lower high, right? Okay, now we have the true lower high. So what do we do next? Now we just look for price to break it. Now how does it break? We don't want a wick break, okay, because that's just liquidity being grabbed. We want candles to close, and one way to do it is wait for one candle to close above it, That's a break. Confirmation is the second candle to break above it. Okay, on whatever time frame you're trading on, whether it's the 5 minute, the 15 minute, the 1 hour, get that confirmation. Is price happy to stay above this high? And if it is, it's a true break, because then if it goes in and then reverses directly out, it's not happy and it's rejecting that area, and that's what you're being told. So when price comes to here, price will drop lower because it rejected this area. At this point here where it's truly broken, we're happy and we can be like, okay, price is happy above there, so we can move away and we can take that trade. So anyway, now we know that's that. We are looking for this high to be broken. It gets broken, and then we take the trade, and then we move up. Oops. Then we move up, and then we continue up. Now, if you're still not confident to do that, don't take trades like this. Instead, look for the continuation trade. Now, I've talked about it a lot on my channel, and it's still a very valid, a very good, and very successful, especially from a win rate percentage and perspective, trade to take. Just take the trade from here, where price has confirmed it's moving in a direction. So now that we've gone over market structure shift, and obviously the same is true for the opposite if I just invert the scale, let's have a look at a couple examples, ones where we're qualifying in and out and making sure we're getting the right trades. Okay, example 1. Going forward, I'm not going to start doing the replay thing because there's no point, because, you know, I get comments of people saying that it's always easy doing it from hindsight. But I want to explain, and I want to be more educational on this channel going forward as well. So if we look at this pre-surprise action here, right, price pushes up. So that's telling us price wants to go up. You know, that could be a news announcement, or that could just be, you know, very good liquidity. We can see there's not much liquidity in the market here. Price is moving really slowly. Then we get push momentum, and it's at 7 o'clock. So that means, you know, that's probably Europe waking up and pushing price. Now, if we look at this price action afterwards, we're moving up slowly, right? Now, price breaks to the downside. What high were we looking at? So that's higher high, higher high, higher high. Okay, so this low here created the higher high here. So what would we be looking at? We'll be looking to take a trade as soon as this gets broken. This candle comes close, rejects it, closes above. This candle with strong momentum, by the way, closes below, closes below, closes below, closes below. At this point here, we're looking for a trade to enter, or a way to enter to this trade, and it's quite simple actually. We have a fair value gap here. You can enter off the fair value gap, you enter this trade. You can target the low, because we know there's going to be a lot of stop losses below the low of a candle this strong, and you will be able to have a very nice trade here of, let's say we just cover the fair value gap candle 8.9, we take it to the low of about 4.72. If we're being very lenient, we can get about let's say a 1 to 3.5 or whatever. Nice easy trade. Okay, there wasn't really any circumstances here for us to qualify out, because everything was in our favor, right? We didn't have to say, is it this one, is it this one, sort of thing. We know which one it is. Price breaks both of them anyway, so you're quite comfortable in saying which one it is. But that's one really good example. Now let's move on to the next one. So let's have a look at example number 2. So as we can see from here, we're in the Asian range. We come out, we've got a high, we've got a low printed in. So which way are we looking to trade, right? So we've got market structure here, okay, and the expectation is for us to take a high or a low of the Asian session. So price is moving down. We got some really nice clear structure in place. Price is moving downwards. So we're looking at a potential reversal to the upside, or some sort of indication that we can take a trade. Okay, and we want to be able to get into a trade where it's either a continuation trade or it's a reversal trade. Now at this time area from like 7 to about, let's say 9-10 o'clock, okay, we know there's going to be volume in the market because London wakes up and starts pumping in. 7 o'clock we get Europe awake, and then 8 a.m. we get London awake. So we're looking at some sort of move, some sort of move that will give us enough pips to take a trade. Now when we're looking at this example here, what can we see? We have clear structure. So there's going to be an idea in our head that we can actually take the trade down. Okay, there is liquidity here from here to here, and we have an order block as well as a fair value gap here. So liquidity, fair value gap, continuous trade, price moving down anyway, we can move down and then take the low here where there was quite a lot of liquidity compared to the high where it looks like it just slowed down, right? Now that's me looking at it from experience. There's going to be, you know, some of you that will be looking at it is, oh, price is moving down. We've tapped into, let's say, something over here. On the lower time frames is likely to be some sort of order block. Let's have a look. Yeah, you're probably drawing out this one here or something here. And then you're like, okay, price moves up. We've taken this high. Price comes down. Here's an order block. You're trying to get into this trade over here. Stops below. And then you're aiming for that high or something, right? Or there's fair value gaps you're trying to go for. You're saying this big move to the downside, liquidity above this high. You got equals here, right? So you're building a case, but you're not qualifying out. Now let's qualify out, right, of this trade. So what I would be doing, as I mentioned as a bit of a hint before, is right, okay, we have a structure break, yes, but we also have liquidity here. Price can just go up, take the liquidity and continue on its way, which it does in this case. Now what else tells me I probably shouldn't be looking for a buy, okay, is when price taps into a very clear order block here, right? We've got a fair value gap here. Price has taken liquidity, it's tapped in, so it's generated liquidity, it's tapped in to take liquidity and it's moved away, okay? And then we come and we spike down. That was the trade to be taken. Well, that's not really accurate, but let's make it accurate. There, price taps in, moves away. Taking a trade at this point was suicide. But the way I guess people are looking at it is slow movement down, rapid movement. Look at the size of this candle. Rapid movement. But look at the way it rejects this area. Fair value gap or order block, whichever one it is, it tapped into. It looks like it's very fine against the order block. But obviously that's just the way it is. And then look at this move down here. That's the type of candle you're like, whoa, momentum's on the side that price wants to move to, which is down. And you can see price comes up again and then it drops down, and that was the trade to take. And then we can see price pushes up again and then wraps its way down. Choppy day in general, because we go back up again and then go back down again during the whole day. But you got to be careful with market structure. Qualify out as well as qualifying in. And yeah, that's it. That's all I wanted to go over. I just saw a lot of comments on my YouTube channel of people asking questions around market structure, so I went over it. If you have any questions, put them in the comment section below. Again, go to my website, enter your email address. I very shortly will be releasing information. I haven't for a while, just been building up you know, the anticipation for the software I'm releasing very soon. It's going to be you know, from like a hint perspective, it's going to be quite cheap for you guys. I want you guys to use it every day, and I think it will be used every day for you all. It will definitely help you up level your trading, and I actually can't wait to release it. It should be released within the next 2 months. But you know, when it gets released, you'll all be notified. So make sure you enter your email address on my website to stay tuned. Thank you, and I'll see you in the next video.